Hey folks, we're diving into the oil debate. The bull-bear case. Will oil crash? Are we heading into a new green sky, a new era for the major oil giants? A lot of this has been kicked off by some of the words Cathie Wood made over a month ago at the beginning of May that have been proving to be relatively inaccurate as ARK's Cathie Wood weighs in on oil sees $70 ceiling. And just to iterate here, ARK Invest Cathie Wood is weighing in on the energy market, saying that electric vehicles will keep crude from breaking out. Speaking at ARK's monthly webinar, Wood predicts a very serious correction in commodity prices and says that she would be surprised if oil prices hit $70 again, according to Bloomberg. But if we actually take a look at the crude prices, here we sit, guys, literally a month and a bit later at $75.19 a barrel, with a lot of blue skies pushing the sucker into all-time highs here, folks. Or, well, not exactly all-time highs, but all-time highs for the year. Is it actually starts hitting highs it hasn't seen since roughly 2018? And are we going to see it break out past year? Time will truly tell, considering, according to Statista, we can see that they're anticipating, according to the average market analyst here, that oil will actually start hitting all-time high uses probably back into 2023-2024 timeframe, with it already increasing obviously in 2021 as we get to the other side of the pandemic, right? But on the side of that too, I can see where she's coming from, considering Tesla continues to hit record deliveries, but how much of those electric car sales can really impede oil prices in the near term is kind of hard to predict out. So what we're going to do is I want to react and just really quickly listen to Tom Lee as he kind of explains why he's kind of bullish on oil, and he's going to generally talk about where he sees the market and FANG stocks going. So let me just full screen this. Let's max the volume out here, folks.
We start off with a record-breaking first half finale. The S&P 500 hitting another all-time high to close out the first half of the year with a 14% gain. So things are off to a great start. Our next guest says, just wait, it's about to get even better. Really? Fundstrat's Tom Lee just hiked his year-end S&P 500 price target by 7% to 4,600. That ties for a street high. Tom joins us right now. Tom, great.
So can we just admire, first of all, that everybody is expecting an over 20% return out of the market this year? Like, nothing has slowed down at all, man. These returns are insane. And I always kind of remind you guys to keep looking at the total return, because everyone thinks dividends, 4% yield, it's all you're going to get. There's a lot going on for capital growth right now.
Great to have you with us.
Great to be here.
You're not worried about slowing growth compared to earlier this year? An economy that reopened in the first half of the year, and an economy that will sort of normalize in the back half of the year with the threat of tapering in some form.
So this is coming from the fact that everyone thinks everyone already pre-stocked up on things like Apple products and just general products through the pandemic, and people aren't really going to be replacing those products again. So people are predicting somewhat of a slowdown in some of the larger retail product kind of companies.
I think that, I don't think recovery is a straight line up, but from what we can tell, looking at both earnings revisions and conference calls and really talking to clients and businesses, I think there's still quite a lot of pent-up demand. I think both on the consumer side, right, there's the revenge spending, and then with both wealth effect and rising stock prices, strong credit markets, I think there's a corporate CapEx cycle coming, which is essentially corporate revenge CapEx. So I think there's a lot of positive catalysts for surprise in the second half.
So you still like energy? Energy was a sector leader first half. You think that's still a winning ticket in the second half?
Yes. To us, energy really sits in a special spot because I know investors, kind of cool to the idea of some inflation plays, but energy and oil really is a supply-demand sector that's got very attractive fundamentals, and then energy stocks have a huge catch-up trade to that. So it remains our top idea.
So look, the reason I can see this being their main top idea is just from the valuation standpoint, because in the near term, even if you're looking to the next 3 to 5 years out, I mean, we're going to see the ramp up in electric vehicles, but not enough, I think, to completely hinge the demand of oil. And when you look at the current valuation metrics, it kind of reminds me of something like the banks, when something like Wells Fargo was just getting beat into the ground, which we saw with oil. Now, this really comes down to the stability of the oil prices and how manipulated that market is, because it's one of the reasons I'm not the biggest fan of the industry, is because there's a lot to go on with carbon tax, a lot of those incentives to get away from oil for a lot of companies. And then on top of that, you obviously have things like Russia and a lot of other people impeding on oil demand prices and just the way everything works, including these moments we're in right now of hyperinflation, and just, that's a whole nother story. But let's continue on.
Where are you on names that really actually underperformed in the first half of the year after being the story of 2020? So to the extent, I know you spend a lot of time going through screens and evaluating underperformance. There are some really gross underperformers in the first half of the year. What do you think about some of those trades?
Tim, if you're referring to some of the secular growth and like the FANGs, I think they're going to be leaders in the second half. I think their turn really came when interest rates and the panic about inflation cooled off in March, and that's, shortly after those stocks bottomed. But when I look at the second half, I think you're absolutely right. If the S&P is going to end the year up 25%, and our rationale for doing that is that strong markets stay strong, then something like Apple or Amazon, which are up 4 or 5%, they could have a second half of 20% just to catch up to where the S&P ends the year. So I think there's going to be a huge amount of price appreciation coming from tech and FANG and some of these secular.
So clearly he thinks that it's exactly the opposite. He thinks that things haven't petered just yet, and we're actually going to see more demand going into the second half of this year. And I know for sure that when the new MacBook comes out, because I haven't bought one yet, I'm going to upgrade my stuff, upgrade my phone. But it comes back to the point of how much people already stocked up on a lot of that stuff. But every bear I've ever heard on Apple has been wrong to date. I'll never bet against Apple for that reason, but I'm kind of on the fence. Kind of hard to predict, $10 billion plus, or literally 30 plus billions and billions and billions of dollars in revenue from these products, right? But let's just keep listening, because man, this guy's bullish.
The growth names. And part of it is, we're not necessarily out of the woods in terms of COVID as well. I mean, I think there's still some uncertainty from investors and, their willingness to embrace epicenter stocks broadly.
Tom, how much attention are you paying to the 10-year yield, being as though it's sort of range-bound and you have both value and growth? Are there any flags that you're worried about as far as yield exploding or falling?
It's a great question. I mean, I don't disagree with the consensus view that rates should be higher in the future, because we have reflation and we have an economy that's recovering. And I think, in general, activity picks up. So there should be sort of reflationary pressures plus the millennials. But I think it's really a question of timing. And to me, I think investors thought there was some urgency about where rates would move to, and maybe a bit of a panic about that. And, the belief that the Fed was behind the curve. Now I think there's kind of a realization the Fed may be correct on a lot of parts of that transitory argument. So I think rates in the shorter term probably undershoot people's expectations. And then that's great for the FANG trade as well.
So, folks, I'm going to leave it here. He gets into Bitcoin and some other deeper conversations, which we can talk about at a later date. I really just wanted to kind of keep this core focused on where his kind of short-term predictions are in the market. And it's kind of funny that the guy stated, hey, you hold value and growth stocks, which, is the only way you can hold a portfolio, in my opinion, because value stocks have really outperformed this year. I mean, you look at REITs, you look at banks, you look at the boring stocks no one wants to talk about. Then you put it with FANG, and holy geez, guys, you're going to the moon, probably making a decent 20-30% return this year easily if you're just invested correctly and diversified properly. And heck, even if you're not, as long as you're buying these big giants and you're picking the big winners, you can't seem to go wrong anymore. But when it comes to oil, guys, this is a fascinating topic of the bull-bear case between somebody like Cathie Wood, who thought 70 is probably going to be the ceiling, but we won't know how much of these statistics come into fruition until we see what the next 2 or 3 years brings. Are analysts right? Are we going to see a full rebound in the value play that could be oil? Or are we going to see an overtake of carbon tax, energy credits, and people more or less driven to be buying electric cars, starting to put a damper on the oil consumption? Who knows? I pass the question off to you. I want to hear what you think in that comment section. Stay cool, stay awesome, and I look forward to catching you tomorrow.